Hello and welcome. You click buy and the price immediately moves against you. Not by much, but just enough to make you feel personally targeted. As if the market has a small camera hidden inside your screen. You tell yourself it is random, then it happens again and again. Eventually, you begin to suspect something uncomfortable. Prices move like crowds and not tidily like equations. That is the starting point of behavioral finance. Markets are social systems that process information through human emotion, under stress, with imperfect attention, imperfect memory, and imperfect incentives. If you want to understand how prices move, you need to understand how people move when money is on the line. Let me give you a simple promise. By the end of this, you will stop expecting prices to be fair in the moment. You will start expecting them to be human. That change will make market behavior feel less mysterious and far more predictable. Start with the most basic question. What is a price? In textbooks, it is the present value of expected future cash flows. In real markets, though, a price is the current clearing point between buyers and sellers who arrive with different stories, different time horizons, and different emotional states. Price is not merely information, it is negotiation. And negotiation produces noise. One of the first empirical cracks in the perfectly rational story is the sheer violence of price movement. Robert Shiller famously argued that stock prices appear far more volatile than can be justified, by subsequent dividend outcomes, a result often described as excess volatility. You can debate interpretations, but you cannot escape the basic observation. Markets swing harder than the underlying cash flows seem to warrant. If prices were purely cold calculations, they would not behave like this. So, what fills the gap between fundamentals and movement? Behavior plus the limits of anyone's ability to correct it. Here is the first behavioral mechanism you should hold tightly. The human mind is not so rational as many might think. In fact, we update our beliefs like a storyteller rather than based on numbers and objectivity alone. Decades of psychology research shows that when people face uncertainty, they rely on heuristics, which are mental shortcuts such as representativeness, availability, and anchoring. In markets, those shortcuts turn into trading behaviors. You see a stock rising, and you infer it as a winner. You see a sector falling, and you infer it as dead. You anchor to a previous price and treat it as meaningful even when nothing about the business has changed. Now introduce loss aversion. Daniel Kahneman and Amos Tversky showed that people dislike losses more than they like equivalent gains, and they evaluate outcomes relative to reference points rather than in absolute wealth terms. In markets, that translates into asymmetry. Fear moves faster than optimism, and people demand a premium to hold risk after being hurt. This is one reason sell-offs can look like trapdoors. You might think, fine, people are biased, but surely smart money arbitrages that away. Sometimes, not always. Schleifer and Fishney's limits of arbitrage argument is central here. Real-world arbitrage requires capital, faces risk, and is constrained by investors, leverage, and timing. Even if a professional believes a mispricing exists, they can be forced to reduce exposure at exactly the wrong time. Thus, mispricing can persist because correcting it is risky and, not to mention, institutionally difficult. This is how behavioral forces survive in markets that are otherwise brutally competitive. So prices can deviate from fundamentals, and they can stay deviated, and they can also move in patterns that look irrational in the short run but are entirely consistent with human behavior and institutional constraint. Now, let us get more specific. How do prices tend to move, empirically? One pattern is underreaction. The market is slow to fully incorporate the implications of new information. A classic example is post-earnings announcement drift. Bernard and Thomas documented that. After earnings surprises, stock prices continue to drift in the direction of the surprise for months, which suggests delayed adjustment rather than instant efficiency. And this is no small curiosity. It implies that even high-profile, widely watched information does not get fully priced immediately. Now, why would that be true? Because investors do not process information as one unified brain. Information is scattered. Attention is limited. Interpretation differs. Some participants react immediately, while others slowly, and some others only after seeing price confirm the story. And that brings us to one of the most important empirical regularities in finance: momentum. Jagadish and Titman showed in their 1993 study that stocks that performed well over the past 3 to 12 months tend, on average, to continue outperforming over the following months, while past losers tend to continue underperforming. Their work helped formalize a simple but unsettling truth. Past returns can, in fact, predict future returns at intermediate horizons. Behavioral finance does not see momentum as magic, however. It sees momentum as what happens when humans update beliefs gradually. Because when news arrives, many investors anchor to prior beliefs, adjust too slowly, and then later pile in when the narrative feels confirmed. And that creates a trend. Hong and Stein offered an influential behavioral model built on gradual information diffusion and heterogeneous participants, news watchers. They underreact, and then we have momentum traders who chase trends, producing short-run underreaction and longer-run overreaction. Notice the rhythm here: slow reaction and then fast reaction. That rhythm is all over market charts. Now, if underreaction exists, you might expect the opposite to exist as well: overreaction. It does. DuBont and Taylor provided evidence consistent with long horizon reversals. Extreme past winners tend to underperform, and extreme past losers tend to outperform over longer horizons, consistent with the market overshooting and later correcting. Behaviorally, this fits a familiar human cycle: initial conservatism and later anchoring, and then narrative enthusiasm, which then eventually leads to disappointment and mean reversion. So you get this odd duality between momentum over months and then reverse over years. Not because the markets cannot decide, but because humans learn slowly, then extrapolate too confidently, then eventually confront reality. This duality is exactly what Barbarish, Slifer, and Fishney aimed to capture in a model of investing sentiment that produces both underreaction and overreaction depending on how people form beliefs from sequences of news. Now let us talk about something you can observe in yourself if you're honest. You do not pay equal attention to all information. You pay attention to what is salient. Barber and Odeon showed that individual investors are net buyers of attention-grabbing stocks, those in the news, those with unusually high volume, or those with extreme one-day moves. That is not because those stocks are always better. It is because attention is a scarce resource. When you face thousands of possible stocks, you search by noticing what is loud. This attention effect helps explain bursts of volume, sudden runs, and the peculiar way narratives pull capital into a small set of names. Prices move not only because fundamentals change, but because attention shifts. Now add overconfidence. A great deal of evidence suggests that investors, especially active ones, overestimate their ability to interpret signals and time decisions. Barber and audience trading is hazardous to your wealth documents that households who trade the most tend to underperform, paying a performance penalty for activity. Overconfidence increases turnover, and turnover increases friction. Yet the behavior persists because people attribute wins to skill and losses to bad luck. This is not merely psychological trivia. Overconfidence is the fuel. It creates demand during uptrends. It creates forced selling after mistakes, and it intensifies the cycle. Then there is the disposition effect. Shevrin and Statman, and later Odeon, using brokerage data, showed that investors tend to sell winners too early and hold losers too long. You can see the logic. Selling a winner locks in pride, while selling a loser locks in regret. Therefore, people delay the loss. This creates predictable supply and demand pressures. It can also slow down the incorporation of bad news, because holders refuse to capitulate until pain becomes unbearable. Put these pieces together, and you can start to see price as a behavioral object. Prices trend because information diffuses gradually and attention comes in waves. Prices overshoot because humans extrapolate and stories become contagious. Prices remain wrong because arbitrage is constrained and professional capital has its own fragilities. Prices swing more than dividends because narratives and discount rates fluctuate with sentiment, fear, and macro uncertainty. So you might ask now, where does macro fit into this? Macro matters, but not as a neat explanatory key. Even careful empirical work finds that a large portion of market swings is hard to attribute to measured macro news alone. Cutler, Poterba, and Summers examined what moves stock prices and argued that it is difficult to explain more than a fraction of return variance with standard macroeconomic news. Even major events do not neatly map onto the magnitude of daily moves. This does not mean fundamentals are irrelevant, though. It means the transmission from facts to prices is mediated by interpretation, positioning, leverage, and emotion. So macro is often the excuse, but behavior is the amplifier. So how should you think about price movement as a coherent story? Think in phases. Phase 1. A piece of information arrives, but it does not instantly saturate. Some participants notice, others ignore it, and others misinterpret it. Underreaction begins. Phase 2. The price starts moving. Attention increases. More people notice the move than the original information. This is the attention channel. Phase 3. A narrative forms. People anchor to recent performance and then extrapolate. Overconfidence increases participation and a momentum builds. Phase 4. Eventually, expectations run ahead of reality. The price embeds perfection, and now overreaction is possible. Phase 5. Disappointment. Tightening, liquidity, or simple exhaustion triggers reversal. People who held losers too long finally capitulate. The crowd moves from denial to urgency. And threaded through all phases is the institutional constraint. Even sophisticated players cannot always stabilize the market because arbitrage is risky and capital has a leash. If you watch prices with this lens, you stop asking, is the market rational? You start asking, which phase are we in? and what behavior dominates right now? That question for you as a trader is far more useful. It also explains why technical patterns, stage analysis, and trend following can work. Trend following is not about forecasting fundamentals. It is about aligning with persistent behavioral flows, underreaction, attention cascades, and institutional herding, while controlling risk when the crowd inevitably changes its mind. One final point. You are not outside this system. You are inside it. If you ever feel a sudden urge to act because a chart moved quickly, that is attention doing its work. If you ever feel pain from a loss that is disproportionate to the amount of money at stake, that is loss aversion. If you ever feel the need to just get back to even, that is a reference point controlling you. If you ever find it easy to sell a winner and hard to sell a loser, that is the disposition effect. If you ever feel certain you have discovered a special insight the market has missed, that is overconfidence. Prices move the way they do because minds work the way they do. And that is the relief that behavioral finance provides. Behavioral finance provides valuable insight that markets are entirely human. Once you accept that, price movement stops feeling like a personal insult. It starts looking like a repeatable pattern. Information comes in, attention surges, narratives form, crowds extrapolate, and reality eventually collects its debt. And that is all part of the system. It is a system built from you and everyone like you, trying to be rational with an animal brain in a world that refuses to sit still. Thanks for watching.